Hey guys, welcome to the Another Excuse podcast, where we chat to founders, creators, and go-getters about how they started and where they are now. Today's guest is Jason Carpenter, founder of Etherbridge, a digital asset fund. In the episode, we discuss where blockchain is heading, the misconceptions of starting your own business, and what central bank digital currencies are. Enjoy the show. Hi, Jason. Thanks for joining me today. So just to give us some context, could you run us through the journey that got you to where you are today?
Yeah, so pretty simple story. I was studying to be a chartered accountant at the University of Stellenbosch. And straight out of university, I was fortunate enough to land a job at a proprietary trading firm. And the real blessing in there was that I had a mentor that sort of passed on his obsession with over financial markets to me. And that was a year of literally just sitting next to a man who was just absolutely obsessed with solving the problem that was financial markets. It was somewhere in that year that my sort of attention to this revolution in accounting specifically, which is exactly what blockchains are, what became heightened. It was the year of 2017. So anyone that was trading things like Bitcoin were having a hell of a time, and I was sort of jealous of the time that they were having. So I thought it would be worth investigating further.
Awesome. And so that led you to starting Etherbridge, is that right?
That led me to obsessing over this new revolution and trying to understand the hype behind what to me seemed like just vaporware. We went to at Stellenbosch. I was meant to be studying the language of business, right? Accounting. And I found it fascinating that at no point in time during my degree did we ever discuss the topic of money. And we certainly never discussed the topic of sort of financial plumbing. So the technology that underpins economies and financial markets. So that was really something that I got very obsessive over. I thought that was super interesting, and it was probably in sort of 2018 where I realized that concepts of money and concepts of financial plumbing were really the blind spot of the traditional financial services space. You've got all these operators, they're highly specialized, but they'd never in their sort of academic path or even in their sort of further education been exposed to philosophical questions like what is money, and then further to that, how does that system all come together. So I became obsessed with this monetary mechanics. So yeah, that's kind of what, even just sort of starting the fund, it was like there's this huge blind spot. Like you can't walk into a financial services firm and get standardized answers to what seem like incredibly basic questions. And I thought that was such an interesting prospect. So we decided to just explore it further.
Awesome. And so what does Etherbridge do?
So Etherbridge is a traditional hedge fund by all means. The only difference is that Etherbridge invests exclusively in digital assets. We invest across all 5 of the core themes of blockchain technology. We are of the belief that we're in a technological revolution, and what we've tried our best to do is to try and understand the sort of vectors through which this new technology will change the world. And we've identified sort of 5 core areas in which we believe that this technology has distinct advantages, either over the current incumbent or where no solution exists, right? Those 5 sort of areas would be the money revolution. So just introducing an alternative to money. Things like Bitcoin would fit into that category. The second one would be the sort of Internet of Value revolution. So transitioning the internet from just read and write to read, write, and own. These would be smart contract platforms like Ethereum, Polkadot, and Polygon. Further, we see a distinct advantage in using blockchain technology to facilitate basic financial transactions. So that would be called DeFi. And just to sort of like imagine what something like DeFi is, it's basically taking every single financial services firm, which you can think of as a tuck shop. There's someone that's standing there that's facilitating a particular service, and you need to trust them in order to interact with that service, and essentially making all financial services a glorified virtual vending machine, where you can go to this thing online and you can sort of participate in basic financial services. It's entirely rules-based. It's available 24/7. It's globally distributed. It has no jurisdiction. So that would be the third category, DeFi. The next category is internet-based services. So if we go back to this vending machine analogy, we can now create rules-based marketplaces for a variety of different computational resources. And we're in the very early stages of these vending machines sort of aggregating enough processing power or aggregating enough storage capacity in order to be able to meet what we believe will be an enormous amount of demand as we head into the future. And then the last sort of very interesting and very sort of high octane area would be media, entertainment, and gaming. So these are bringing ownership to games. It's bringing a new sort of methodology for interacting with your end client. A lot of people will throw around the word NFT, but an NFT can be it can be sort of merely a medium for being able to better interact with your end client. Whether you use that medium to provide them with exclusivity or membership or some form of loyalty point system, you can use NFTs to sort of manufacture more sophisticated and more expressive relationships with your end client. And in all honesty, we have so many examples of these digital NFTs in the world that we live today. Every single company or coffee shop has a loyalty program. They have an internal accounting system, and all we're doing is slapping on new terminology and new infrastructure to something that is been going on for ages. So those are the five sort of categories that we invest in. And then when it comes to how we think about investing in the space, our goal is to preserve capital and to find home runs. Now, the only difference in when we say preserve capital is we're talking about Bitcoin or ETH capital, right? So our goal for our clients is that when they enter the fund, they leave with more Bitcoin. And the way that we attempt to do that and have been successful in doing that since inception is by identifying home runs. And those home runs can be found in sectors like DeFi and sectors like smart contract platforms and media and entertainment.
I know you touched on NFTs along with all the other aspects that you look into, but do you think there's a slight disconnect between the average person and people within the space purely based on terminology and things like that? Do you think we are losing possible users because it's such a complicated space?
Absolutely. And I think this is the same as almost every industry, right? Like you create complex terminology in order to sort of preserve your knowledge over others or onlookers into the space. And if I had to just describe the basic changes in terminology, every single digital intermediary that exists today, these are your sort of like Facebooks in media, these are your PayPals, these are your rising neobanks, and then even sort of e-commerce platforms. All of them at their most basic are just databases of user accounts, assets, and a whole bunch of highly sophisticated algorithms or business logic that allows them to manage those assets in an optimal way on your behalf as the user. So the future, because of this new infrastructure, is going to create new digital intermediaries. And those digital intermediaries are going to look, feel, and taste very similar. But instead of having user accounts where we use an email and a password to log into our favorite digital intermediary, we're now going to use public and private keys. Instead of our assets being represented in non-standardized forms in various silos all over the internet, we're now going to see them represented by standard or standardized tokens. In the Ethereum ecosystem, we already have two very, very commonly used token standards. One for fungible assets. So these are great for representing financial assets, like what you'll see in financial intermediaries, debits and credits, stocks and bonds. And then we've also got a non-fungible token standard, which can be used to represent assets that are unique. I mean, when I say assets, I'm talking about a whole range of different assets: financial assets, digitally consumable assets. Your data and your content on your media companies are assets. And if you don't think they're assets, then go have a look at the stock price of the companies that you provide that information to for free. Even representing physically consumable assets is technically possible. I think that there's a long road to walk before we can do that. Before we can do that in an efficient and sort of optimal manner. But representing physical assets with NFTs is also something that's totally possible over time. Whether we're there yet is very much up for debate.
Yeah, I know a company like StockX or even Nike themselves are looking at that type of physical representation on the blockchain. So you don't need to physically hold the assets and you can trade them more frequently, which saves a lot. It like saves time and can save like fuel and all those type of costs that go into simply just trading a shoe can now be simplified by having a representation on the blockchain.
Absolutely. And I mean it's not perfect. We're still figuring these things out as this technology diffuses through society. I think the last piece of terminology that's sort of important for people to understand is, instead of referring to the business logic that Facebook has as algorithms, we'll start referring to them as smart contracts, right? So the names change, but the sort of function remains relatively the same. So those are really probably the three most important things that people need to understand about the change in terminology. It's user accounts become public and private keys, assets become tokens, business logic becomes smart contracts.
Definitely. Yeah, I think once the user experience is seamless, then the back end won't really need to matter. It doesn't matter. We don't need to know exactly how it all works for mass adoption. So everyone seems to have a crypto origin story. How did you start to learn about it and what got you into it?
My origin story is quite sad, actually. My current partner, Michael Haynes, approached me in 2013 and described Bitcoin to me. I don't know if it's on him or on me, but he described this thing to me, and he's like, "Listen, if we solve these puzzles, we can like earn this magic internet money." And I was still very sort of convinced on my trajectory into becoming a chartered accountant. And I think I had sort of an inflated confidence in my understanding of how the world worked. And I told them, well, you're silly. This makes no sense. It's not backed by a government. It's never going to work. So that was in sort of 2013. And then when I was at that prop trading firm, one of the biggest problems that they had was that every time they went offshore, this was a South African-based prop trading firm, every time they went offshore, they would get sort of destroyed by currency moves. Every time they came back on shore, the same would happen. So they were brilliant equity speculators, but terrible at sort of understanding currencies. And that sort of took me down a journey into understanding currencies. And I guess my sort of aha moment was just reading financial history, and just sort of identifying the fact that, we live very short lives on this sort of rock that's hurling through space. And there's much bigger cycles that sort of exist outside of our very small lifespans. And when you start to see that throughout financial history, there's always been a rotation between credit-based money, which is the money that we're all accustomed to using today. People call it fiat money. And this other form of money, which is commodity-based money, then this sort of story starts to make a little bit more sense. And, even if there is a 1 to 3% chance that commodity money rises again, and just so happens to rise in the form of Bitcoin, because Bitcoin is technically just a digital commodity, then it's definitely an area worth paying attention to and worth investing in.
And personally, I've been blown away by like the sense of community in the space. But what do you enjoy about working in the space?
I love the fact that everything is incredibly new and sort of experimental. I love how quickly it iterates. I love the fact that it is probably the most competitive place on planet Earth. All of this stuff is being done open source. There's nowhere to hide. I think like one of the things I find most fascinating is that with a few lines of code, these entrepreneurs are attempting to disrupt trillion-dollar industries. Even if you just look at the sort of cost basis of a DeFi application relative to a fintech application, these networks have a huge distinct advantage over the thing that they're trying to disrupt. And then you add on the sort of competitive nature of this industry, the fact that it's all open source, the fact that good ideas can and will be copied. It becomes just hyper competitive, and then over time, and as we've seen in the last sort of 3 years, hyper efficient as well. We're still miles away from producing a truly 10x better product in all 5 of those categories than what we have today. But I'm willing to bet that we get to sort of parity within the next 3 to 5 years, and then within the next 5 to 10 years, we really shoot the lights out with truly 10x better consumer products.
And so starting your own thing is completely different to working for someone else. What drove you to start your own business?
I don't think I really thought that much about it. It was almost like a given that I was going to start my own thing. I didn't really think about it too much. I didn't weigh up the sort of working for someone else versus doing my own thing. I've always sort of thought about decisions in life as choose your hard. running a startup is super, super hard. Building business is super, super hard. Working for someone is really hard. And it's just choosing which hard you're going to go with. I would say that going this route is I would assume a lot more rewarding than working for someone else. But I've also got a lot of evidence to suggest that maybe that's not necessarily the case. But I didn't really think about it too much. It was just a given.
Interesting. So did you have like a strong support group? What was your social circle's view on you starting your own business and it being in Web3? I feel like that's a double blow of the social norms.
Yeah, I mean, I think I was super fortunate that I had an incredible group of friends around me that were, I think a lot of them thought that I was completely off my rockers, and for good reasons. But none of them sort of threw that in my face. All of them seemed incredibly supportive of what I was trying to achieve. And pretty much all of them stood by me in trying to achieve that. I think that, when we were really sort of getting into the swing of things, we did very well in our first sort of year or so. So it was quite validating that we were heading in the right direction. And yeah, I was just incredibly fortunate to have the right group of people around me that enabled me to keep pushing and keep moving forward. They were all also incredibly competitive in their own realms. So I think that they understood what I was trying to achieve and where I was trying to go. And I even, when I started Etherbridge, I started it with Mike Haynes, who was a mate of mine since we were 14. That was probably the thing that I got the most pushback on was, oh, Jason, don't start a business with such a good friend. Things can get ugly. But, in hindsight, probably the single best decision I've made in the last 6 years is working with Michael. So yeah, I'm glad it sort of worked out, and my friends are still around. So clearly I haven't messed that up too much. But yeah, I think I was fortunate in that regard.
And so right at the beginning, was there any inkling of fear at all? Were you worried that it wouldn't work out, or were you just like, I'm going to make this work no matter what?
Yeah, I mean, we'd already just, I was in my brain already managing $1 billion of other people's money. For the first sort of 2 years that we were in this journey, we didn't actually have a formal fund structure. So we spent a lot of our time doing research and building conviction. We spent a lot of time at Masari standardizing white papers into something that would allow you to sort of more accurately compare and evaluate projects on sort of terms that made sense. And yeah, I don't think we ever really looked back. We definitely had very, very dark days where we considered, is this something we want to do? I guess the best way to sort of put it is we came to the industry with dollar signs in our eyes, and we ended up staying for the technology. The more we focused on the technology, the more difficult it became to even think about stepping away from this thing.
I think everyone has a similar sort of story in terms of their interest is sparked by the dollar signs. And then over time, you realize that there's a lot more to it. And purely, if money is your motivation at the beginning, you have to learn all the different aspects of the technology, how it all works, to try and make more money. And then because of that, you end up learning so much more about it, and you realize that there's actually something here. So what are the most important lessons you've learned from running your business?
I think one of the biggest things we got wrong in our early days was a sort of inability to delegate roles and tasks. So when you're in the very early days, you want to like sort of have your hands on everything. And we were just a two-man team, just Mike and I, and we needed to find ways to sort of allow each other to run as hard and as fast in our own lanes as possible. And that probably took us 2 years before we were sort of comfortable in doing that. So this resulted in, almost doing double the work that we were meant to be doing, doubling up on each other, sort of not allowing each other to really be pushed to the maximum within the lane that we sort of chosen for ourselves. So that would be a big one. Is I wish we delegated earlier and faster, and then took responsibility and ran. The second one would just be communication. When things get tough, people get emotional, and when people get emotional, a lot of the sort of pent up things that they wish they had said all of a sudden just get spewed. Mike and I we've worked really hard on being able to effectively communicate with one another. And then, further to that, not only be effective in our communication, but never take anything to sort of heart. Never, we're both fighting for the same thing. We're both heading in the same direction. Everything that we say to one another is additive to going in that direction. And I think once we establish clear rules for communication, everything just became a lot more seamless. And then I think the last sort of point is probably around sort of not overthinking things, but sort of ticking the right boxes. So in every decision that you're going to be faced with, you need to have done thorough due diligence on why you're doing whatever you want. And all these decisions need to be made on a sort of risk-adjusted basis. But you also need to be making decisions very quickly. And you can't be scared of making those decisions. There's so much fear of messing things up in the early days. And in hindsight, a lot of the things that we were worried about in our early days are just completely irrelevant when I think back on what was actually important. So make calculated decisions quickly and develop frameworks to help you think through these problems without being so mentally taxing.
What would you say are the classic misconceptions about starting your own business?
I know people say it's hard, but I think people sort of undersell just how much bad stuff happens to you when you're starting your own business. And I think the most important thing before talent, before strong skill sets, before pretty much anything else is just absolute and utter grit in getting to your end goal. If you can develop a super thick skin, if you can take no's and sort of move on as quickly as possible and not drop your head, that's really sort of where you want to be. So I know people say it's hard, but it's super hard. And if you've got the right people around you, if you create frameworks to think clearly, it can be a lot easier. Another big misconception that I had, and I think this came from my sort of background with sport, was at sort of high school or at university, everything was 90% performance and 10% everything else. So if you were the fastest and you trained the most and you got to the swimming gala on the weekend, you won the race. What we have sort of realized at least in the Etherbridge context, was that it's actually 90% everything else and 10% performance or product. In our sort of case, relationships are almost everything to our business. And to give you an idea of just how important those relationships are, we're obviously very sort of closely tied to the crypto market cycle, which means that our fund is volatile because we're long only always. And that means that you need to, have an incredible relationship with your investors. I'm pleased to say that we've only ever had one redemption from our fund in a year that we were drawn down 64%. And that redemption came on the back of that investor actually just needing liquidity. So I think that probably the single most important thing in bringing a successful product to market is working on the relationships that will help you distribute that product. You can have the best product in the world. You can be the top number one performer in the world, but if you don't have the relationships to get that product into the right people's hands, you're going to have a very, very difficult time getting that thing off the ground.
The concept "fake it till you make it" is thrown around a lot. Do you think it's true in a sense?
Yeah, I think it's absolutely true. When you say that, I think of imposter syndrome, which is something that we've dealt with pretty much since we started. I think we only started to feel it after about 2 years of being in this space and sort of realizing, oh, jeepers, like there's so much we don't know. We thought we knew everything, but there's actually so many unknown unknowns. But I've also been super fortunate in that I've been able to talk to so many credible financial experts. And the thing that always strikes me is just, all of these guys are all just trying to figure it out. Even guys that I, respect immensely, they still have the same sort of doubts about their capabilities or about their knowledge or about what happens next. So that's something I think that, will just be with you forever. I don't think it's something that leaves. And yeah, you've just got to back yourself. And it is, I guess, fake it till you make it, but understand that everyone is faking it till they make it. And then when they make it, they're still faking it.
Yeah, that's such a valuable lesson to learn. I feel like once I learned that, it gave me more confidence to pursue the things that I was interested in. When you realize that everyone is actually on the same page and they might only be a few steps ahead of you, but they're just delivering it with confidence, and that's really the key. So what aspect of yourself or your business do you feel like you need to improve on?
I think we've been so stuck behind the screens. We've been so stuck behind our process as a fund. We've been so stuck behind our product that we've forgotten the social side of business. And that is something that we're actively working on now. So it goes back to, talking about the sort of 10% product, 90% everything else. The one thing that I know for a fact that I can improve tremendously on is the sales process and is the relationship management. Sales are, again, best product, no distribution. Sales are absolutely essential to having success in almost any business, I think. So it would probably be sales skills. I do think that there are sales skills that are very much, they learned behaviors. You can actually learn to be a great salesman. So we're working actively on that. There's something else that we could improve on. I think, increasingly, and we actually had a conversation about this the other day, increasingly it's becoming a sort of non-negotiable to have an online presence. That's also something that we're looking at improving on hugely, and that again goes back to the conversation on imposter syndrome or fake it till you make it. And if you're a perfectionist like Mike and I have tried to be, you find it quite difficult to put your ideas out there, to participate in sort of social spaces online, and the quicker you can alleviate yourself from that and get in there and participate and be willing to be wrong, be willing to have an open mind, be willing to sort of allow yourself to change your mind on things as well, the better. So yeah, sales and online presence, I think, are two ingredients in success that we're looking at working very hard on.
Definitely. I can relate to the sales one in particular. I feel like it's such a valuable skill. And after doing all the research, knowing like it's something I need to improve on, it tends to boil down to just doing the reps, which most things boil down to that. Just doing the reps, practicing, and you'll get better. But also like the hurdle that you're dealing with posting online, it's like another one of those mental hurdles that seem huge and will only get smaller once you get over it a few times. So now like I'm also interested in Web3, and I think it would be silly not to nerd out for a second and go a bit deeper into your thoughts on the current state of affairs. So what's your assessment of where the space currently stands?
So, I mean, I think we're in the equivalent of 2019. I think we've had our big sort of relief rally. And I think that the back end of the year is going to be either flat or to the downside. So if you're sort of holding the long tail of crypto assets, I think you're in for a rather painful second half of the year. We have a terrible macro backdrop. Even the macro guys can't forecast it. So I won't even begin to pretend like we have a crystal ball that's telling us what happens macro-wise. We have the entire regulatory apparatus of the United States sort of against digital assets for various very political reasons. And, those three things combined together, so, no liquidity for crypto speculation, regulatory uncertainty, is causing allocators to sort of pause and wait for some of these unknowns to become a little bit more clear. So it's a tough space to be in at the moment, but I think we're on our way to seeing a massive compression in multiples for many of these assets, and there already exists opportunities to buy DeFi protocols, for example, at sort of 2 times earnings. Right? These are businesses that are growing at sort of more than 100% a year in terms of users and liquidity in their systems, and you can buy them at 2 times earnings. I think that on its own is a very interesting opportunity. In terms of themes that we're very interested at the moment, there is the crypto AI intersection. And the way that we've been thinking about that is, one of the interesting sort of use cases there is sort of Uber for GPUs or Uber for processing power. If you just pull up a chart of Nvidia, you'll see just how valuable the market thinks GPUs and processing power is going to be going forward. And with blockchains and with smart contracts that create these sort of virtual vending machines, we can stock these virtual vending machines with processing power that's distributed all over the world. So you can now actually start to tap into excess processing power sitting on my laptop here in London, and I can, as a provider of that, monetize that and actually earn a fee or a rent for doing so. And if you just look at how expensive it is to train these AI models and the amount of processing power that they require, there's definitely going to be demand for this excess spare capacity that can be facilitated through smart contracts. I think the second sort of area of that intersection would be, if you've ever used ChatGPT, you'll see whenever they post a message, they have a thumbs up or a thumbs down button. So that's what they call reinforcement learning with human feedback. And again, because we have these virtual vending machines, we can attach sort of permissionless economics to them, right? Where people can come and contribute feedback to these AI models and earn a fee for doing so. So you can create incentive schemes that allow you to tap into hundreds of thousands of people all over the world and get their feedback in order to improve your models. And then the last area, which we haven't fully sort of thought through yet, is that there's definitely going to be a need for people to be able to sort of authenticate themselves when they're posting an original piece of content or a picture that they've drawn or created. I do think that somewhere in there, cryptography and public and private keys will play a role. I'm still not fully convinced on the sort of shape and form that is going to take and how that's going to be achieved. After all, an AI could theoretically spin up a wallet or spin up a public and private key, right? So there's many challenges in that sort of third dimension that need to be thought out. Another thing we're super excited about is decentralized exchanges, and specifically exchanges that cater for margin trading. With everything that happened with FTX last year, there is massive room for an open source, blockchain based, very transparent version of FTX. So you could think of it as a decentralized FTX. There are already a couple big players in that space. DYDX sort of comes to mind, so does Synthetics, and so does GMX. So we're watching that very closely. There's clearly a market demand for something like that. There's always going to be interest for scaling technologies. There's a lot of action around layer 2s, whether they be on Ethereum or on Bitcoin, which is something I'll touch on just now. But that's definitely an area to watch. That's definitely, as we continue through sort of the 2019 price action, those are definitely areas worth finding gems in and loading up. And then, the sort of final thing is, I guess, the most exciting is that Bitcoin is actually exciting again, right? We've been through a sort of innovation slump when it comes to Bitcoin. I know that, many Bitcoin proponents will point to things like Lightning as like an indicator of massive success, but I don't think that Lightning has been close to as successful as evangelists have made it out to be. I do think that it's an incredibly interesting component to Bitcoin, but I don't think that it is its final shape and form. But with the advent of ordinals and inscriptions, and then further to that BRC20 tokens, I think that we're about to get into a massive sort of innovation cycle on Bitcoin specifically. And I just want to sort of add one thing to that. It's like we have this mantra of like, follow the developers, follow the developers. One of the most difficult things for developers interested in Bitcoin was how they monetized their interest in Bitcoin. And because there's now a bigger sort of design space for what's possible on Bitcoin, there's bigger salaries, there's bigger opportunities. So we're actually starting to see developers come back to the Bitcoin ecosystem. And if you look at what Bitcoin sort of total amount of developers are over the last sort of 3 years, and you compare the sort of momentum they're starting to get now, Bitcoin was probably, out of a list of 20 smart contract platforms, Bitcoin was probably 18, 19 in terms of, the amount of developers that were actually coming to the ecosystem. So this is a super exciting moment for Bitcoin, where I think we're finally going to see massive innovation that's native to Bitcoin, which is something we've been waiting for a very long time.
You touched on the macroeconomic situation a bit, but there's usually a correlation between price cycles and the Bitcoin halving. Firstly, could you explain what the Bitcoin halving is, and then whether you think price action will be similar in this coming cycle, or if it'll be different due to the macroeconomic situation?
So the halving is essentially Bitcoin executing on its predetermined issuance schedule. When I say issuance schedule, Bitcoin has a natural inflation rate. So every single year, X amount of Bitcoin can be mined, new Bitcoin can be mined or minted. And every 4 years, the amount of Bitcoin that can be mined per block actually halves. So at the moment, I think we're at about 6.25 Bitcoin that can be mined per block. And by April or May 2024, miners will only be earning about 3.125 Bitcoin a year. Now, in terms of this halving cycle, the halving cycle is super interesting because I think in the very early days, the halving itself was exceptionally positive for price, because the sort of change in the inflation rate was quite large relative to the existing stock. And if we just think about how miners operate, miners are profit maximizing entities, right? They provide computational power, they have a hell of a lot of very expensive hardware, and they have massive electricity bills, all denominated in fiat, that they need to sort of put to work, mine Bitcoin, and then liquidate or sell that Bitcoin in order to cover these fiat denominated fees. So the logic of the sort of halving cycle has always been, okay, miners are going to be mining less Bitcoin. Their costs are probably going to stay relatively the same. They're going to be mining less Bitcoin, which means they're going to be sort of selling less Bitcoin in order to remain a going concern. I don't think that effect is going to be as dramatic in this cycle. And if it is as dramatic, I think it's more a perception-based driver of price appreciation than some fundamental structural driver of price appreciation. So will it be mega positive for Bitcoin going into 2024? Again, I think it has a lot more to do with what's going on in macro land than what's going on with Bitcoin's issuance schedule. There's also this meme of like the Bitcoin halving is priced in. Maybe it's priced in for guys that have been around for a very long time, but it's certainly not priced into the guys that read headlines and are newcomers to the space, right? And are buying Bitcoin predominantly because they have 4 cycles of evidence to suggest that buying it before a halving makes sense. So it's probably the story that's more important than the actual structural change.
That makes sense. So regulation is becoming a huge talking point for blockchain. Are you worried about regulation, or do you think that it validates the space?
We welcome fair regulation. I can sympathize with regulators to an extent. These are individuals that are not paid to take risks, and they're also, deeply sort of tied to the current sort of apparatus that exists for doing these things, right? So this sort of gets to the heart of what blockchains are disrupting, and primarily blockchains are disrupting financial market infrastructure, at least in the world of financial services. And I think that regulators are stuck in a very difficult situation where the creative sort of destruction that comes as a result of opening the regulatory door to this industry by providing fair and manageable regulation will be terrible for the incumbents, right? We're talking about zeroing out equity in a number of financial services businesses. It's almost like these guys are afraid of what they allow us to disrupt, and just how sort of earth-shattering that might be for those who are involved. So I do welcome regulation. In fact, the number one pushback that I get from prospective clients today is that super interested in the space. I'm super aligned with the ethos of the space, but I cannot allocate or invest until regulators sort of protect me when I do allocate. I mean, I think this is something that like a lot of people don't quite understand, but like regulation will create the conditions necessary for real money to enter the space. We're in this sort of speculative financial capital phase of crypto, where it's just guys coming with some disposable income, speculating on some coins, having a bit of fun. If we want to start seeing production style capital, these are like mega businesses bringing billions and billions of dollars to build on this new technology and this new infrastructure. It needs to be regulated. They need to be protected if something were to go wrong. There needs to be some kind of legal process if something were to go wrong. So I'm very excited to sort of see where the regulatory conversation gets us. I think that regulators know a lot more about the industry than they sort of than the sort of evangelists say they do. I think that they're very well aware of the consequences of opening the door to this regulation, and they're just trying to think through those consequences before they do so. And then, you know, also in their sort of favor, there is, well, not in their favor, but to their credit, there are numerous bad actors and bad things happening in the industry. There's also a whole category of assets that are clearly securities. That's why in our process, when selecting assets, one of the big filters that we put assets through is the Howey test. We try and understand, you know, what are the risks associated with this thing being a security, and would this thing be better off as an asset if it was a security? I think that, you know, if you look at, there's this school of thought in crypto, or this field of study in crypto called token economics. And I think that if regulators just came in and provided clarity, we would stop thinking just about token economics, and we would get back to thinking about how can we create genuine value accrual methodologies to maximize token holder value. And until regulators provide that kind of clarity, all of these projects are stuck in these very sort of reflexive business models that are very difficult to value, that are very difficult to sort of gain a full comprehensive understanding of. There are obviously, you know, some that are much better than others, but without that clarity, it's very difficult for founders and entrepreneurs to truly think through the best value accrual methodology for their token.
Interesting. So I want to shift over to a possible dark side of regulation, if you will. Most nations seem to be working on some form of central bank digital currencies, or CBDCs. Could you explain what these are, and then like the pros and cons of them, and your views?
Sure. How long do you have? So central bank digital currencies are just digital dollars or digital rands or digital whatever local currency you're dealing with. They don't necessarily need to be on a blockchain, but their form is fully digital. There are two distinct types of CBDCs that have very different outcomes if implemented. There's the wholesale CBDC, which in my view would serve the same sort of role as the accounts that banks have with central banks, and would only really help with interbank settlement. They would greatly reduce costs associated with interbank settlement. That form of CBDC we wouldn't see much of that as users of our local currency. We would probably see massive efficiency gains when transferring value between banks, and perhaps even when transferring value cross borders. But that's assuming that, these governments are all going to come together and sort of agree on some standardized rails, which I guess we already have today in the form of SWIFT and the Bank of International Settlements. And then there's the other version, which is the retail CBDC. Now, this digital form of money would be a lot more similar to cash. So the relationship would be between you as the user of the currency and the central bank that issues that money. So a retail CBDC would technically be a liability of the central bank to the private sector or to households. That is probably the sort of real breakthrough if you can fully trust your governments and you're like super happy about what your governments are going to be sort of monitoring. There are sort of a lot of people talking about how CBDCs could be manipulated. So, for example, I can't remember the exact terminology, but in the United States, they're starting to sort of flag people or put a red mark against your name if you go and buy ammunition, or you go and buy a gun, or if you go to a driving range. Now, that's probably a bit of a sort of more philosophical question as to whether, being categorized like that and further to that, potentially discriminated against because of that is a good or bad thing. I think that I could probably make arguments on both sides. So whether CBDCs are a good or bad thing is a deeply political, deeply ideological conversation, right? Let's focus for now on the good side, and then we can sort of throw some bones on the bad side. On the good side, you could completely upgrade your ability to conduct monetary policy, right? We operate in a world today where our monetary policy is pretty ineffective for the little guy. It's very effective for systemically important institutions and whoever is closest to the sort of pipe where the money comes out of, but it's certainly not great for the little guy. If you totally trust your politicians and you believe what they say, they will say that, listen, we could use CBDCs for more direct, more targeted monetary policy intervention. And in a world where we're all using a retail form of CBDC, first of all, we've gotten rid of the majority of the role that commercial banks play in the financial system. So we've essentially nationalized banking as an activity. And we now have the ability to identify pockets of the economy that have been affected by some kind of shock and directly stimulate those pockets of the economy. And we can even attach additional rules to that. So if there's a big shock for some commodity, we can actually sort of directly stimulate people that are being affected by that shock. And further to that, we can add rules as to how they can spend that money. And if we believe that, we being the government, if we believe that spending in a particular category of the economy is more beneficial than spending in another, then we can sort of close the gate to only be able to spend in one category of the economy. I think one example could be, apparently cow farts are sort of going to kill the world. When we give you our CBDC, you can only buy X amount of red meat, right? Again, deeply philosophical, deeply ideological conversation. I could probably argue both sides. If we go to the bad side, it just comes down to, how much can you trust these people, and how much of your civil sort of liberties are you willing to give to these people? There's a fascinating podcast with a man called Rohan Gray on the Bankless podcast. And I thought that his points on this topic were just brilliant. His insights were just incredible. And I'll try and do his point of view justice here today. He is basically saying to the crypto community, he is saying, guys, if we don't get into the streets and fight for private public money, right? So this is, if we don't fight for a digital equivalent of cash in the public realm, it's going to be impossible to fight for the ability to hold assets like Bitcoin and Ethereum that are technically privately issued currencies. And I thought that was just such an incredible take, because that's the thing that sort of unites the no-coiners and the Bitcoiners. Like, we all want our civil liberties protected. We don't all, want to be tracked every second of the day, and we certainly don't want to have red flags on us that will affect our ability to get a loan, that will affect our ability to interact in a particular way, just because we bought a gun, or because we went to the shooting range, or because we, I don't know, bought a sex toy or something ridiculous, right? And there is a common sort of fight here, whether you're into crypto, whether you're not into crypto. Having public payment infrastructure that isn't facilitated by profit maximizing private companies is vitally important to a successful economy. And I think that's something that we can sort of be aligned on. So there are even people within government that are fighting directly against the narrative that the crypto community talks about when they talk about CBDCs. There are allies within the government that aren't Bitcoiners. They're not interested in crypto, but they're interested in the same ideological beliefs that we should have public payment infrastructure that is private. So I thought that was a very interesting sort of way of thinking about it.
We're at such an interesting intersection of so many new developments happening all at the same time. And I mean, you did touch on AI a bit. And I mean, personally, I think everyone should be paying some form of attention to AI. Are there any particular AI tools that you've turned to or used to improve your workflow?
No, I think I love messing around on ChatGPT. It's certainly sped up a lot of the work we do in R and around the data that we interact with. It's probably increased my efficiency. It's at least doubled it, if not tripled it. Another interesting thing that we've been doing is there's these sort of spin-offs like Chat with PDF, and then further the browser plugin that's now available on ChatGPT. And our biggest sort of problem is that there's just so much going on all the time. And what we need to do is we need to like standardize and distill the most important aspects of any given project into something that we can use to compare and evaluate against others. And essentially what we do is we'll go onto something like ChatGPT, and we will provide it with sort of 10 different resources about a particular project and ask it to give an answer to, call it anything from 15 to 20 questions. That creates a document that then becomes the sort of first layer of due diligence that goes into analyzing any given project. And if you think about how that just dramatically increases our efficiency and our coverage, I think it's exceptional what these tools can do. I mean, we were looking at hiring analysts, and we've had to backtrack on that now, because for $20 a month, you've got a software engineer, a marketing agency, and a content writer and a research analyst in your pocket, right? It's insane. So we've seen it and affect our workflow massively.
Yeah, it's crazy. And it's all just advancing so fast. So Web3 seems like a topic that people are intrigued about, but they never end up learning about it. I touched on this at the beginning of our conversation, but my assumption is because it has such a steep learning curve and user experience isn't as simple as it needs to be. Do you have any suggestions or resources or people to follow for someone starting out or wanting to learn more about Web3 in the space?
Yeah, I mean, I'll use this opportunity to sort of plug our blog. Our blog has a variety of different tutorials and guides that people can use to better understand the space and equip themselves with skills to be able to navigate the space. I did hear about something quite interesting. It was, I think, MetaMask. Was it MetaMask? MetaMask has released like a sort of Web3 academy. So you can actually go and get paid for doing tutorials and learning about how to use some of these technologies. And then there's also Learn Web3 DAO, which is the guys actually from Zim, and they've created almost like a Web3 sort of university. So if you're already a developer, or you want to become a developer, or you just want to learn the basics, you can go to Learn Web3 and you can build some serious skills.
Awesome. Very, very useful resources. Now people don't have an excuse. So
Yeah.
Thanks for joining me today, Jason. I learned a lot. So you mentioned your blog. Where can we find your blog? Where can we learn more about you and Etherbridge?
Awesome. Yeah. You can find Etherbridge at etherbridge.co. If you would like to book a call and hear more about the fund, you can do that directly on the website. We've also got our blog, which is etherbridge.substack. And then you can find me on LinkedIn. You can find us on Twitter at Etherbridge. And yeah, very keen to engage with anyone who's interested in crypto. My emails are always open if you can find my email address. But Twitter DMs or LinkedIn DMs are always open if you're interested in this space. If you have any questions or you just want to explore, give me a shout. I'm always keen to chat about magic internet money.
Awesome. Thanks, Jason. Have a great day.
Yeah, you too. Thanks, brother.
Thanks for listening. I hope you learned something new today. Everything we discussed will be in the show notes. And if you want to learn a little bit more about Web3, then check out those resources that Jason mentioned. See you next week.